Welcome back to Start My Home Journey, where we make homeownership accessible and achievable for everyone. In our last video, we explored 5 innovative ways to buy a home without relying on traditional bank loans. Today, we're diving deep into the first method, seller financing. Whether you're a buyer looking for flexible financing options or a seller wanting to attract more buyers, understanding seller financing can open up new possibilities for both parties. Let's get started. Seller financing is a real estate agreement where the seller acts as the lender, allowing the buyer to make payments directly to them instead of obtaining a mortgage from a bank. Essentially, the seller finances the purchase and the buyer repays over time, similar to how a traditional mortgage works. This method can be particularly beneficial for buyers who may face challenges securing a traditional loan due to credit issues or unconventional income sources. For sellers, it's an opportunity to upgrade from being a landlord to becoming a lender, enjoying the benefits of steady income without the responsibilities of property management. Let's explore the pros and cons of seller financing from the buyer's perspective. Pros: flexibility in terms. Unlike traditional bank loans, seller financing offers more negotiable terms. You can work directly with the seller to find an agreement that fits your financial situation. This could mean lower down payments, flexible interest rates, or extended repayment periods. Faster approval. Without the need to go through a lengthy bank approval process, you can close the deal more quickly, moving into your new home sooner. This speed can be crucial in a competitive market where delays could cost you the property. Opportunities for buyers with poor credit. Seller financing is often more accessible for buyers who have lower credit scores or irregular income, making homeownership possible when traditional financing isn't an option. Sellers may be more lenient with credit requirements compared to banks. Cons: higher interest rates. Sellers may charge higher interest rates than a bank, leading to higher overall costs over the life of the loan. This is often because the seller is taking on more risk by lending directly to you. Balloon payments. Some seller financing agreements include a balloon payment at the end of the term. This large lump sum payment could be challenging if you're not prepared, potentially forcing you to refinance or sell the property to cover the payment. Fewer legal protections. Unlike traditional mortgages, seller financing doesn't offer the same level of legal protection. Traditional mortgages come with regulatory safeguards that protect the borrower, such as standardized foreclosure processes and clear disclosure requirements. In seller financing, the lack of these protections means that the buyer must be more vigilant in ensuring the contract is fair and legally sound. Limited refinancing options. Refinancing a seller-financed loan can be more challenging. Traditional lenders may be hesitant to refinance these types of loans, and the original seller might not be willing to renegotiate terms. This could lock you into the original terms for the entire loan period, even if market conditions change, potentially paying a higher price. Because of the flexible terms offered, sellers may charge a higher sale price. You might end up paying more for the property than you would in a traditional sale, as sellers may use the favorable financing terms as a reason to increase the overall cost. This is something to carefully consider when negotiating the deal. Now, let's take a look at the pros and cons of seller financing from the seller's perspective. Pros: upgrade from landlord to lender. As a seller, you transition from managing tenants and dealing with property maintenance to enjoying the steady income of loan payments, with the property itself serving as security. This can significantly reduce your day-to-day responsibilities while still providing a steady cash flow. Attract more buyers. By offering seller financing, you can attract a broader range of potential buyers, especially those who may not qualify for traditional loans. This can be particularly advantageous in a slow market where finding qualified buyers can be challenging. Steady income stream. Seller financing provides a steady, predictable income stream with interest, potentially yielding more over time compared to a lump sum sale. This can be especially appealing for sellers looking for long-term income. Potential tax benefits from capital gains. Instead of realizing the full capital gain from the sale in a single tax year, which could push you into a higher tax bracket, you can spread out the gain over several years. This installment method can reduce your overall tax liability. making the sale more tax efficient. Potentially higher sale price. Because you're offering flexible financing, you may be able to negotiate a higher sale price for your property. Buyers are often willing to pay more for the convenience and accessibility of seller financing. Cons: default risk. There's always the risk that the buyer may default on payments. In this case, you may need to initiate foreclosure or take back the property, which can be a lengthy and costly process. While the property itself serves as collateral, the process of reclaiming and reselling it can be burdensome. Ongoing involvement. Unlike a traditional sale, seller financing involves ongoing involvement in the loan management process, which may require time and resources. This includes keeping track of payments, managing the loan, and possibly dealing with late payments or defaults. Legal and financial complexity. Setting up a seller financing deal requires careful legal and financial structuring to protect your interests. This typically involves working with attorneys and financial advisors, adding to the cost and complexity of the sale. Property value fluctuation. If the property's value decreases, you may be stuck with a less valuable asset if you need to reclaim it due to buyer default. This risk is especially relevant in volatile real estate markets where property values can fluctuate significantly. Whether you're a buyer or a seller, here are some key tips and eligibility requirements to ensure a successful seller financing experience. Clear and detailed contract. Both parties should work with a real estate attorney to draft a comprehensive contract that clearly outlines all terms, including payment schedules, interest rates, and responsibilities for maintenance and repairs. Eligibility of the buyer. Sellers should conduct thorough due diligence on the buyer's financial situation, including checking their credit score, income stability, and overall financial health to minimize the risk of default. Down payment. Agree on a substantial down payment to reduce the seller's risk and ensure the buyer is committed. A higher down payment can also provide the seller with immediate liquidity. Interest rate negotiation. The interest rate should be fair but reflective of the additional risk the seller is taking on. Both parties should agree on an interest rate that aligns with current market conditions and the buyer's financial situation. Repayment schedule. Set a realistic and manageable repayment plan that works for both parties. Consider the length of the loan term, monthly payment amounts, and any potential balloon payments. Default clauses. Include clear default clauses in the contract that outline the steps to be taken if the buyer fails to make payments. This can include foreclosure procedures or repossession of the property. Consult professionals. Both parties should consult with real estate, legal, and tax professionals to navigate the complexities of seller financing. Proper guidance can help avoid potential pitfalls and ensure a smooth transaction. Seller financing can be a powerful tool for both buyers and sellers when approached with a clear understanding of the benefits and risks. If you're a seller, upgrading from landlord to lender could be the perfect opportunity to enjoy steady income with less hassle. And don't forget the potential tax benefits.